All right, listen to me carefully. Lock in for the next few minutes, because what I'm about to share with you is not speculation, it's not a theory, and it's definitely not financial doom porn for clicks. This is a real policy framework, a real legal mechanism, and it's already been adopted by regulators across more than 24 jurisdictions worldwide, including the United States, the United Kingdom, the European Union, and Australia. And the name of this mechanism is one word that should send a chill down your spine. Bail-in. Now, if you don't understand what a bail-in is, I'm going to explain it to you in the simplest, most brutal way possible. A bail-in means that when a major bank fails, your money can be used to save the bank. Not your taxes, not the government's money, not a bailout. Your deposits, your savings, the cash you think is safe because it's sitting in a checking account with a friendly logo and a polished app. If your deposits are above the insured limit, regulators can legally convert them into equity. That means your cash gets turned into shares of a failing institution. You go to sleep as a depositor. You wake up as a creditor. Or worse, a shareholder in a bank that is collapsing. And you don't get to vote. You don't get to negotiate. You don't get to opt out. It happens over a weekend. Quietly. Legally. Efficiently. And by the time you understand what happened, the doors are already locked. Now, let me say something very clearly, because this is where people get emotional and start calling it impossible. This is not coming. It is already here. The legal framework is already built. The precedent is already set. The paperwork is already signed. And the institutions behind it are not small. We're talking about the Financial Stability Board, the Bank for International Settlements, the FDIC, the ECB, the IMF, the same organizations that write the rules for the global financial system. And if you think they built these laws for fun, you're not paying attention. They built them because they know what's coming. And they know the next crisis cannot be solved the way the last one was. In 2008, the banks were bailed out with taxpayer money. The public was furious. Governments took political damage. And the trust in the system cracked. So after 2008, the regulators quietly changed the playbook. They said, next time, we're not bailing out banks. We're bailing in depositors. And the terrifying part, they sold it as fairness. They sold it as stability. They sold it as responsible resolution. But in reality, it's legalized confiscation. It's a stealth wealth transfer. And it's designed for one reason, to keep the banking system alive at your expense. Now, why does this matter today? Because we are entering a macro environment where the probability of needing bail-ins is higher than it has been in decades. Global debt to GDP is at all-time highs. Governments are drowning. Central banks are trapped. And the traditional tools, bailouts, money printing, quantitative easing, are politically exhausted. The public won't tolerate another massive rescue of bankers. And the government can't afford it anyway. So the next crisis won't be solved by printing money and writing checks. It will be solved by converting your deposits. That's why you need to understand this now. Not later. Not after the headlines. Not after the bank run begins. Now, because by the end of this video, you will understand exactly how bail-ins work, why they're legal, why they are inevitable, and most importantly, what you can do to protect yourself before the trap closes. And yes, there's an action plan. A real one. Not vague advice. Not diversify. Not stay calm. A real strategy. But first, I need you to understand something that frames everything. We are no longer living in a normal investment environment. We are living in a regime change. A financial regime shift, where the rules are being rewritten in real time. And most people have no idea. So let me introduce you to the only rational framework for this era. It's called asymmetric wealth preservation, and it's the difference between being crushed and coming out the other side stronger. Here's what it means. In a normal world, you balance risk and reward. You diversify. Stocks, bonds, real estate. You assume the system stays stable enough that the rules don't change overnight. But this is not a normal world anymore. In a system under extreme stress, the downside risk of staying inside traditional instruments becomes catastrophic, while the upside of moving into hard assets becomes exponential. That is asymmetry. And the greatest asymmetry in the modern world is this. If you hold wealth inside the banking system, you're playing a game where the rules can change instantly. But if you hold wealth outside the banking system, you're playing a different game, a safer game, a game where your assets cannot be digitally frozen, cannot be converted, cannot be reclassified, cannot be restructured, because you hold final settlement. And final settlement is the one thing regulators can't rewrite with a memo. Now, before we go deeper, let's prove something. This is not new. This has happened before. And history is not a suggestion. History is a blueprint. The first parallel we need to look at is the Great Depression. Most people remember the stock market crash of 1929, but the real collapse happened between 1930 and 1933. Inside the banking system, more than 9,000 banks failed in the United States. 9,000. That is not a typo. And those failures weren't just because of bad management. They were because banks promised depositors something they could never actually deliver: liquidity, safety, immediate access. But the reality of fractional reserve banking is brutal. The bank doesn't keep your money in a vault. It loans it out. It invests it. It uses it. So when depositors lost confidence and rushed to withdraw, the banks couldn't meet the demand. And the result was a cascade of bank runs that destroyed the savings of millions of Americans. So what did the government do? They created the FDIC, and that's the part everyone remembers. But what most people forget is what came next. They confiscated gold. Executive Order 6102. The U.S. government made it illegal for citizens to own gold bullion. They forced people to sell it to the Federal Reserve at a fixed price. And then they revalued gold higher immediately, which devalued the dollar overnight. A wealth transfer from savers to the state, done under the guise of emergency. And here is the lesson. In a systemic crisis, governments rewrite the rules. They seize, they revalue, they restrict, they do whatever is required to protect the system, not you. The second historical parallel is the 1970s. Stagflation, a toxic mix of inflation, economic stagnation, unemployment, and collapsing trust in the dollar. In 1971, Nixon closed the gold window. The Bretton Woods system died, and the world entered monetary chaos. Inflation went to double digits. Real interest rates went negative. Cash became poison. Bonds became a slow-motion trap. And what happened? Gold exploded from $35 an ounce to over $800. Silver went from around $1.50 to $50. Why? Because in an era of currency debasement and collapsing confidence, people flee to hard assets, not because they want to get rich, but because they want to survive. They want purchasing power. They want something that cannot be printed, cannot be debased, cannot be restructured. And the people who positioned early didn't just preserve wealth. They multiplied it. They benefited from systemic dislocation. Now let's bring it into the modern era. Cyprus, 2013. This is where the bail-in framework was tested openly for the first time. The Cypriot banking system collapsed. Bad loans. Exposure to Greek debt. The government needed a bailout, but the EU and IMF made a demand. Before any external money would come, Cyprus had to raise capital internally. How? By confiscating deposits. Deposits above 100,000 euros were hit with haircuts. Some people lost up to 60% overnight. And those funds weren't just taken. They were converted into equity, worthless shares in a failing bank. Depositors became shareholders, and the regulators called it a success. Because from their perspective, it worked. The banks were recapitalized. The crisis was contained, and taxpayers didn't directly pay. But Cyprus was not an accident. Cyprus was a template. After 2013, the Financial Stability Board formalized bail-ins as the preferred mechanism for resolving systemically important banks. Then it was codified in the United States, Title II of Dodd-Frank. In the EU, Bank Recovery and Resolution Directive. In the UK, Banking Act. These laws give regulators explicit authority to convert deposits, bonds, and unsecured liabilities into equity during a resolution process. And here's the part that shocks people. Systemically important does not mean only the biggest banks. It includes regional banks, banks with tens of billions, banks you've never even heard of. Because in a fragile system, a regional failure can trigger a national domino effect. Now, let's connect this to the environment we're in right now. Because bail-ins don't exist in a vacuum. They exist for one reason: debt, global debt. According to major financial tracking institutions, total global debt is now in the hundreds of trillions. Public and private, governments, corporations, households. It's a debt supercycle, and it's reaching the end. The United States alone is drowning in debt. And when you include unfunded liabilities, the real number becomes terrifying. And here's the brutal truth: this is not sustainable, and the political will to fix it doesn't exist. No government wants austerity. No government wants default. No government wants to admit reality. So what's the alternative? Financial repression. And this is where the trap becomes invisible. Financial repression is when governments deliberately keep interest rates below inflation, meaning they steal from savers slowly. They force you to lose purchasing power every year, while the real value of government debt melts away. It's a stealth tax, a slow-motion wealth transfer, and it has been happening for years. Even when the Fed raises rates, real rates often remain weak or negative, meaning cash is still losing. And here's the nightmare: that cash isn't just losing value. It's also trapped inside a bail-in framework. So you're being hit from both sides. Inflation erodes your money, and bail-ins can confiscate what's left. Now, let me show you how this works in the United States in plain terms. Because once you understand the mechanics, you'll never look at a bank account the same way again. Let's say a major regional bank runs into trouble. Commercial real estate defaults. A derivatives blow up. A wave of withdrawals. Confidence collapses. The bank becomes illiquid. It goes to regulators. The FDIC steps in. Under Dodd-Frank, they have the authority to take control and begin a resolution process. Shareholders get wiped out. Bondholders get hit. And if more capital is needed, uninsured deposits are converted. Any deposit above $250,000. That's the FDIC insurance limit. So if you had $500,000 in that bank, $250,000 is protected. The other $250,000 becomes equity. And you're now holding shares in a failing institution. Maybe worth pennies. Maybe worth zero. And you didn't choose this. It was done to you, legally, over a weekend. And when the bank opens on Monday, your money is gone, replaced with a paper claim, a digital share, a polite illusion. Now here is the darkest part. Banks are required to hold something called loss-absorbing capacity. And under international guidelines, uninsured deposits are counted as part of that buffer, meaning your deposits above the insured limit are already being treated as a tool for recapitalization. You just weren't told. So now the question becomes, if this is real, and it is, then what do? This is where most people freeze. They get scared. They feel powerless. But you're not powerless, because there are asymmetric moves you can make right now that completely change your position in this game. And there are three primary plays. The first, and the most historically proven, is physical precious metals, gold and silver, not ETFs, not paper claims, not allocated products inside a bank. Physical metal, because gold and silver are unique. They are liquid. They are portable. They have no counterparty risk. They cannot be debased. They cannot be printed. And they cannot be bailed in. When you hold physical gold or silver, you own final settlement outside the system. No intermediary. No third party, no bank, no regulator, no op, just real value. And historically, in every banking crisis, precious metals preserve purchasing power. But silver is even more interesting, because silver is both money and industrial necessity, and its market is smaller, meaning when demand spikes, it doesn't rise slowly, it explodes. The gold-to-silver ratio is still elevated compared to long-term averages, which means silver remains undervalued relative to gold. And in a true crisis, silver tends to outperform in percentage terms because it's smaller, more volatile, more sensitive, more explosive. And when paper markets break, silver becomes the most asymmetric hard asset on Earth. The move here is simple. Allocate a meaningful portion of your liquid net worth into physical gold and silver. Not 1%, not 2%. If you understand systemic risk, 10% minimum. 20% is better. And if you truly see what's coming, 30% is not crazy. Because you are not investing. You're escaping the trap. The second asymmetric play is decentralized stores of value and real asset diversification. Now, yes, this includes things like Bitcoin, and I know that triggers people. But from a systemic risk perspective, it functions like a digital form of gold. Fixed supply, outside the banking system, not easily confiscated if you control your keys. And beyond that, real assets matter. Land, energy, commodities, productive assets that generate real value. Because in an era of financial repression, assets tied to real-world utility survive, while paper claims get diluted. The third play is jurisdictional and structural diversification. This means you do not keep all your wealth in one bank, one country, one legal system, because in a crisis, capital controls happen fast, and they happen inside jurisdictions. If all your money is domestic, you're trapped inside domestic rules, and those rules can change overnight. So spreading risk matters. Multiple banks, multiple structures, multiple jurisdictions if you have significant wealth. And no, this is not about tax evasion. This is about asset protection, because the people who run the system do not keep their wealth in one place. And you shouldn't either. Now, let's make this practical, because understanding is useless without action. Here is what you need to do right now. First, assess your exposure. Go through every bank account. Add up your deposits. If you have more than $250,000 in any one institution, you have uninsured deposits at risk. And that risk is not theoretical. It is legal. Move that money. Spread it across multiple banks. Or convert a portion into assets outside the system. Second, establish physical precious metals. If you own none, start immediately. Buy from reputable dealers. Bars and coins. Hold it yourself in a secure safe. Or use allocated segregated storage outside the banking system. Not ETFs. Not paper gold. Not digital silver. Because in a crisis, paper claims become trapped. Physical is final. Third, reduce exposure to long-duration bonds. In a financial repression environment, bonds are a guaranteed loss in real terms. And in a crisis, they get haircut too. Shorter duration, inflation protection, real assets. Fourth, if you have significant wealth, think about jurisdictional diversification. A foreign account, a stable legal environment, a structure that creates separation between you and your assets. Optionality is survival. Fifth, educate yourself. Because the biggest danger is not the crisis. The biggest danger is being uninformed inside the crisis. Read the laws. Understand the rules. Follow independent analysts. Because mainstream media will never explain bail-ins to you. They will never tell you the truth about financial repression. And they will never give you an action plan. They will tell you everything is fine until the day it isn't. And then they will blame you for panicking. Now, here is the question I want you to answer in the comments. Do you currently hold more than $250,000 in uninsured deposits in a single bank? And if you do, what is your plan? Are you waiting for more confirmation? Or are you taking action now? Because I'll tell you something you need to hear. In every crisis, the people who waited for confirmation became victims, and the people who moved early became survivors. This is not about fear. This is about clarity. This is not about panic. This is about positioning. Because the next crisis will not be solved with bailouts. The next crisis will be solved with bail-ins. And the vast majority of people are completely unprepared. But you're now informed. And if you act, you don't just protect yourself. You position yourself for the largest wealth transfer in modern history. So if this video gave you clarity, if it connected the dots, if it gave you a framework, do me a favor, hit subscribe, turn on notifications, and share this with someone you care about. because the mainstream financial system is not going to warn them. And by the time the headlines arrive, the doors will already be locked. Take action. Stay sharp. Stay informed. And I'll see you in the next update. Because what happens next will redefine money and rewrite the rules of wealth for the next generation.